Hi, hello, how are you all? Welcome to my channel Law Made Simple with me Vidyarthi. Today let us learn the new topic Law of Taxation. What is taxation and what is the necessity to impose tax and who is authorized to impose tax and what are the benefits for imposing the taxes? So, the taxation power is derived from Article 265 and let us learn and get into the topic. The system of taxation is the backbone of the nation's economy, which keeps the revenue consistent, manages the growth in the economy, and then fuels the industrial activity. So, India has got three-tile federal structure, which consists of union government, state government, and local bodies. What does local bodies include? They include local councils and municipalities. So, the government of India is authorized to levy taxes on individuals and organizations only according to the constitution. And in that, Article 65 of the Indian Constitution states the right to levy or charge tax has been given to any except the authority of law. Only the authority of law has the charge to levy the tax. The seventh schedule of the Constitution has defined the subjects on which the union or the state or both of them can levy taxes. So, as per 73rd and 74th amendments of the Constitution, limited financial powers has been given to the local governments which are enshrined in Part 9 and Part 9A of the Constitution. So, from this Article 265, we have come to a conclusion that only by the authority of law, only those authorities, which one, the union government or the state government, and depends upon the subjects on which they have to levy taxes, is governed by the law of Article 265, and the local government has very limited authority to impose, and those are enshrined in Part 9 and Part 9A of the Constitution. Let us learn what is the definition of tax. A tax may be defined as a monetary burden rested upon individuals or people with property to help add to the government's revenue. Only the people who earn can add a revenue to the government by paying taxes, right? Tax is therefore a mandatory contribution and it's not a voluntary payment or donation which one decides on its own. So it is a mandatory payment which should be decided by the law. According to the law, that government imposes the taxes and that should be paid, and it's not a voluntary or some kind of donation. It is the payment extracted by the legislative authority. It may be a direct tax or indirect tax. Revenue growth, which may be a little faster than gross domestic product, what that is GDP, can result from the revenue mobilization with an effective tax system and measures. So, only by collecting tax the revenue can be mobilized and there can be a development and effective tax measures and can be done in accruing this tax from the individual's pocket. In short, it is a tax imposed by the contribution made by the individuals according to the law based upon their salaries or income generated. The government uses this tax to carry out several functions like social welfare projects like schools, hospitals, housing projects for the poor, infrastructure such as road, bridges, flyovers, railways, ports, and for the security infrastructure of the country like military equipment, enforcement of law and order, pension for the elderly, and the benefit schemes to the unemployed or the ones below the poverty line. So these are all the schemes or developments made by imposing tax on the individuals' pockets. Article 265. Without the authority of law, no taxes can be collected is what this article means in simple terms. The law here means only a statute law or an act of legislature. The law when applied should not violate any other constitutional provisions. This article acts as an armor instrument for arbitrary tax extraction. So we have a case law here. In the case of Lord Krishna Sugar Mills versus Union of India, the sugar merchants had to meet some export targets in a promotion scheme that is started by the government. But they fell short of the targets, then additional excise tax was imposed on the shortfall. The court intervened here and said that the government had no authority of law to collect this additional tax. What this means in effect that government also cannot levy this tax by itself because it has not been passed by the parliament. So only the power is only on Article 265, on what basis, on what authorities, on what subjects they have to levy taxes. Into what are the objectives of taxation in modern public finance? We have several developments happening by collecting the taxes. For example, economic development. One of the important objectives of taxation is economic development. Economic development of any country is largely conditioned by the growth of capital formation. It is that capital formation is the kingpin of economic development. But least developed countries usually suffer from the shortage of capital. So to overcome the scarcity of capital, government of these countries mobilize resources so that rapid capital accumulation takes place. To set up both public and private investment, government taps tax revenues. Through proper tax planning, the ratio of savings national income can be reached. By raising the existing rates of taxes or by imposing new taxes, the process of capital formation can be made smooth. One of the important elements of economic development is that raising of savings income ratio, which can be effectively raised through taxation policy. So in this objective, the economic development is completely based on the country's capital formation. So any country's capital formation is the key for the economic development. So what happens in the very least developed countries, they usually suffer from the shortage of capital. So they do, if there is any kind of tourism in that country, they use those resources to rapidize those capital accumulation. So to set both public and private investment, government will keep on tapping the tax revenues. So in this way, economic development happens. Coming to full employment, since the level of employment depends upon the effective demand. So if there is a demand for that process, there will be a employment. So a country resides for achieving a goal of full employment must cut down the rate of taxes. So when there is a process, if there is a country which is having 90% or more than 90% of the employment, then obviously the taxes will come down. Consequently, disposable income will rise and hence demand for goods and services will rise, and increased demand will stimulate investment, leading to the rise in income and employment through the multiplier mechanisms. So in turn, these are all interdependent on each other. When there is a full employment, there will be a demand for goods and services. Obviously, when goods and services increase, the commodities increase, there is a purchase, whereas income is generated or capital is accumulated into the government's pockets. Government's treasure. Coming to price stability. So these taxes are regarded as effective means of controlling inflation. There are two types of taxes, direct taxes and indirect taxes. When direct taxes are imposed, obviously the pressure on commodity market is reduced. Thereby, we have lot of commodities sold out, and obviously the national capitals will rise up, and inflation there is a less chance of inflation. But when there is indirect tax imposed on commodities, obviously there are lot of increase in the prices of the commodities, which discourages the consumption and also encourages the people's savings. So the opposite effect will occur when the taxes are lowered down during deflation. How to control these cyclic fluctuations? Control of cyclic fluctuations, periods of boom and depression are considered to be another objective of taxation. So during this depression, taxes are lowered down, while during booming, taxes are increased so that cyclic fluctuations are tamed. So this is clear. Reduction of balance of payment difficulties. Taxes like custom duties are reduced to control imports of certain Taxes like custom duties are also used to control imports of certain goods with the object of reducing the intensity of balance of payment difficulties and encouraging domestic production of import substitutes. So there is an imposition of a customs tax also only to encourage the domestic products consumption, or encourage the commodities of domestic origin. So instead of having the imported products, it's better to use domestic products to reduce the balance of payment difficulties. And coming to non-revenue objective, extra revenue or non-revenue objective of taxation is the reduction of inequalities in income and wealth. So this can be done by taxing the rich at a higher rate and the poor by introducing the system of progressive taxation. Next, we have social and economic balance. Every individual's earnings and overall economic situation, the government has well-defined tax slabs and exemptions in place so that income inequalities can be balanced out. This is straightforward. And it curbs inflation. How the government often increases the tax rate, and when there is a monetary inflation, which in turn reduces the demand for goods and services, as a result, descending demand, inflation bounds to condense. So, by imposing taxes, there is a chance for curbing the inflation also. Minimization of inequalities in consumption standard. So, by taxing items of conspicuous consumption and luxurious meant for the rich classes at a highly progressive rate and subsiding the essential goods meant for the poor sections of the community. So, there has been high tax imposed on the consumption of luxurious items, or you can see the consumption of alcohol as well as the cigars and the cigarettes. The rate of tax is higher than other commodities. Coming to protection of domestic industry. To provide protection to the domestic industries, the import duties are usually devised in developing economies. So India is also imposing heavy import duties on many items with the object of encouraging the production of import substitutes and protecting the domestic industries from cutthroat foreign competition, and also to conserve valuable foreign exchange reserves by curbing the propensity to import. So it is better to use you improve the domestic industries rather than to import, so that the level of taxing curbs or the inflation curbs. As such, we have come to the end of the session. It's riddle time. Please answer the riddle in the comment section. Please like, share and subscribe. Thank you.